Right now, at this exact moment, something is happening in the financial system that is quietly affecting every single person in this country. Your mortgage, your savings, your retirement account, your grocery bill, your car payment, every single one of them is being moved by a force that most Americans have never heard of, do not understand, and have never been warned about. And the people who control that force, the biggest banks, the largest investment funds, the most powerful financial institutions on the planet, they are all doing the same thing right now. They are nervous. And when these people get nervous, regular people lose money. I am going to tell you exactly what is happening, exactly why it matters to your specific financial situation, and exactly what you need to do about it before it is too late. But first, I need to show you something that will change the way you look at your money forever. Stay with me, because what I am about to show you in the next few minutes is something most people will never see until it is already too late. I want to take you back to a specific moment. It is the middle of May 2026. A number appears on a screen in a trading room in New York City. The number is 4.67. It does not look scary. It does not look like a crisis. It is just a number on a screen. But in the room where that number appeared, experienced traders who have been doing this for 30 years went quiet. Because that number was not just a number. That number was the yield on the 10-year United States Treasury bond. And when that number hit 4.67%, it crossed a threshold that told every serious financial professional in the world that something had fundamentally shifted. Let me explain what that means in plain language, because nobody ever explains this part. The United States government borrows money constantly, every single day, to fund itself, to pay its bills, to keep the lights on. It borrows that money by selling bonds. Essentially, it goes to investors and says, lend us your money for 10 years and we will pay you back with interest. The interest rate it has to offer to attract those investors is called the yield. When investors trust the economy, when they feel confident about the future, they are willing to accept lower interest rates. They do not need to be bribed to lend money because they believe everything is fine. But when investors are nervous, when they see something in the economy that worries them, they demand more. They say, if you want our money, you are going to have to pay us more for it. And when they demand more, the yield goes up. When the yield on the 10-year Treasury hit 4.67%, it was not just a market event. It was a message from every serious investor in the world collectively saying, in the only language the financial system understands, we are not confident. We want more money to take this risk. Something is wrong. And here is what makes this personal for you. Whatever the United States government has to pay to borrow money becomes the floor for every other interest rate in the entire economy. Your mortgage rate, your car loan, your credit card, your business loan, everything sits on top of that government rate. When the government rate goes up, everything above it goes up with it. So when that number hit 4.67, your mortgage got more expensive, and most people had absolutely no idea it was happening. Now here is where it gets important, because most financial news will tell you the yield went up and leave it at that. But nobody explains the 3 specific reasons why this is happening right now and why each one of those reasons is a direct threat to your personal finances. Let me give you all 3. The first reason is inflation, and it is not as under control as you have been told. The official inflation rate right now is 3.8%. That number is almost double the Federal Reserve's target of 2%. Think about what that means. The Fed has been fighting inflation for years. They raised interest rates to levels we had not seen in decades. They caused real pain in the housing market, the car market, the small business market. All of that pain was supposed to bring inflation back down to 2%. And they got it partway there, but they could not finish the job. Inflation stopped falling and got stuck at 3.8%. And now it is starting to creep back up because of factors the Fed cannot control with interest rates alone. Here is what 3.8% inflation means for your money in practical terms. If you have $100,000 in a savings account earning less than 3.8%, you are losing purchasing power every single day, even though your balance looks the same or higher. The number on your screen is going up, but what that number can actually buy is going down. That is the silent tax that nobody ever puts in a headline. And here is the part that should make you genuinely angry. The big banks are paying you 0.5% on your savings, while they lend that same money out at 7, 8, 9, 10%. They are profiting from the exact inflation that is eating your savings. savings, and they are counting on you not knowing that there is a better option sitting right in front of you that requires about 30 minutes to access. I will get to that option in a few minutes. Write that down because it is the single most actionable thing in this entire video. The second reason the bond market is nervous is the size of America's debt and what it is about to cost every single one of us. The United States government currently owes more money than at any point in the history of the country, and this year, 2026, is a particularly dangerous moment for that debt because a massive amount of it is coming due all at once. Here is the number that stopped me cold when I first saw it. $8 trillion. That is the amount of existing government debt that is maturing this year and needs to be replaced with new debt. $8 trillion in 1 year, not to build new things, not to fund new programs, just to roll over existing debt that is coming due. To put that in perspective, the entire United States economy, everything produced, every service performed, every product sold in an entire year, is worth approximately $28 trillion. The government needs to borrow an amount equal to more than a quarter of that just to replace debt that is expiring. And here is what makes this genuinely dangerous for your money. The cost of carrying all this debt has tripled since 2021. The United States government is now paying more than $1 trillion every single year just in interest payments, not paying down the debt, just the interest. $1 trillion a year going out the door before the government spends a single dollar on roads or defense or social security or anything else you actually benefit from. And a new tax bill that was recently passed is projected to add another $5 trillion to that debt over the next 10 years. $5 trillion on top of the debt that is already crushing the government's finances. Why does this matter to your money? Because when the government needs to borrow that much money, it has to offer high yields to attract buyers. When it offers high yields, every other interest rate in the economy goes up. Your mortgage goes up. Your car loan goes up. Your credit card goes up. The government's debt crisis becomes your personal debt crisis. The third reason is the one that nobody is connecting to your finances, and it is the most immediate. Energy prices, specifically what is happening with global oil supplies right now due to geopolitical instability in the Middle East. I know that sounds like something that happens far away and does not affect you, but here is how directly it connects to your wallet. When oil prices rise, everything that gets made costs more. Everything that gets shipped costs more. Everything that gets grown costs more. The price of oil is embedded in the cost of every single product you buy. When oil spikes, inflation spikes. When inflation spikes, the Fed cannot cut interest rates. When the Fed cannot cut interest rates, mortgage rates stay high. Car loans stay expensive. Credit card rates stay elevated. Your cost of living stays elevated even while your wages try to catch up. The energy situation right now is adding fuel, literally, to an inflation fire that was already proving difficult to extinguish, and bond investors know this. They see it. They are pricing it into the yields they demand, which is why that 10-year Treasury yield has been climbing and staying elevated even when the market hoped it would come down. I want to stop talking about abstract numbers for a moment and show you what this is actually doing to real families right now. Meet a couple I am going to call Michael and Karen. Michael is 58, Karen is 56. They have been responsible their whole lives. They saved, they paid their bills on time, they built equity in their home, and 18 months ago they made a completely reasonable financial decision that is now costing them thousands of dollars more than they planned. They took out an adjustable rate mortgage to keep their monthly payments manageable while rates were high, planning to refinance when rates came down. Rates did not come down the way they expected. Their mortgage is adjusting upward. Their monthly payment has increased by $420 from what it was when they signed. That is over $5,000 a year coming out of their retirement savings that they did not budget for and did not plan for. They are not alone. There are millions of Michael and Karens right now. People who made reasonable decisions based on reasonable assumptions about where interest rates were going and are now dealing with the real-world consequences of a bond market that is telling a very different story than they expected. Or consider a 64-year-old woman I am going to call Patricia. Patricia has been a disciplined saver her entire adult life. She has $85,000 in a savings account at her local bank, earning 0.45% annually. That is her emergency fund. That is the money she knows is safe and accessible. What Patricia does not know is that her $85,000 is generating $382 a year in interest. At 3.8% inflation, her money is losing approximately $3,230 of purchasing power every year. Patricia is doing everything right by the standards of conventional wisdom. Keep money in the bank, keep it safe. And she is losing over $3,000 a year in real terms without a single dollar leaving her account. The bank knows this. They are keeping the difference between what they pay Patricia and what they charge borrowers. And they are counting on Patricia not moving her money because moving money feels complicated and risky, and most people never do it. But it is not complicated, and it is not risky. And in about 5 minutes, I am going to show you exactly how Patricia and you can fix this with a single 30-minute action this week. I know what you are thinking right now. You are thinking, is a recession coming? Just tell me yes or no. Here is the honest answer. The economy is not in recession right now. GDP is still growing. The labor market is still relatively stable. Consumer spending is still happening. If you look at those numbers in isolation, everything looks fine. But here is what I have learned about recessions. They never look like a crisis until they already are one. Every recession in modern history was preceded by a period where the official numbers looked okay, while the underlying pressures were building quietly. The 2008 crisis did not announce itself. The 2001 dot-com collapse did not send invitations. They built slowly and then happened very quickly. And right now, the underlying pressures are the clearest I have seen in years. Inflation stuck above target with the Fed unable to cut rates. Government debt at historic levels with the cost of carrying it consuming more of the budget every single year. Energy prices being driven higher by geopolitical instability. Bond investors demanding higher yields to compensate for risks they are clearly seeing. A housing market that has locked tens of millions of people out of buying or selling because rates are too high to make the numbers work. None of this means a recession is certain, but it means the conditions for one are present, and the people who protect themselves before the crisis are always in a dramatically better position than the people who react after it. So the question is not whether a recession is coming. The question is whether your money is positioned to survive well if it does and continue growing if it does not. Everything I have told you until this point was context. This is the part that actually matters. These are the 5 specific moves you need to make based on everything the bond market is telling us right now. Move 1. Stop leaving free money in a low-yield savings account. This is the single highest impact, lowest effort financial move available to any American right now, and most people are not doing it. If you have money sitting in a traditional bank savings account earning less than 3.5%, you are effectively paying an inflation tax every single day. The money is there, it looks fine, but it is losing purchasing power faster than it is growing. High-yield savings accounts at online banks are currently paying between 4 and 5% annually. That is not a risky investment. That is not stocks. That is not crypto. It is a savings account backed by the same FDIC insurance as your regular bank account. The only difference is the interest rate. If you have $50,000 in a traditional savings account earning 0.5%, you are making $250 a year. Move that same $50,000 to a high-yield savings account earning 4.5% and you make $2,250 a year. A difference of $2,000 every year for doing nothing more than transferring money from one account to another. The banks offering the highest rates right now include Ally Bank, Marcus by Goldman Sachs, and several others. Search high-yield savings account rates today and you will find current options. This takes 30 minutes. Do it this week. Move 2. Learn about Treasury bills before your next financial decision. Treasury bills are short-term loans to the United States government. You lend the government your money for anywhere from 4 weeks to 1 year, and they pay you back with interest. Current yields are between 4.3 and 5%. Here is what makes Treasury bills special. They are backed by the full faith and credit of the United States government. For all practical purposes, they are the safest investment that exists. And right now, they are paying more than most savings accounts. You can buy them directly with no fees, no broker, no middleman, no commission. You go to the website, you create an account, you buy the bills directly from the government. The interest you earn is exempt from state and local taxes, which makes the effective yield even higher than the headline number. Many people right now are building what is called a Treasury bill ladder. They buy bills maturing at different intervals, 4 weeks, 8 weeks, 13 weeks, 26 weeks, so they always have money coming available while the rest continues earning yield. It is one of the most sensible financial strategies available in the current environment, and it requires no financial expertise to execute. Move 3. If you have an adjustable rate mortgage, act now, not later. If your mortgage rate is going to adjust in the next 12 months, you need to have a conversation with your lender this week, not next month, this week. The options available to you narrow as you get closer to the reset date. Ask specifically about converting to a fixed rate. Ask about what rate you will reset to if you do nothing. Get the real numbers in front of you and make a deliberate decision rather than letting the calendar make it for you. If you are planning to buy a home in the next year, recalculate your budget using today's rates, not last year's rates, not the rates you were pre-approved for 6 months ago. Today's rates. The monthly payment difference between what was available 18 months ago and what is available today is significant enough to change what you can comfortably afford. Know the real number before you commit. Move 4. Review the bond allocation in your retirement account. This is specifically for anyone within 5 years of retirement. The conventional advice to shift toward bonds as you approach retirement is sound in principle, but dangerous in execution in the current environment if you are not paying attention to what kind of bonds you are holding. Long-duration bonds, meaning bonds with 10, 20, 30-year terms, lose significant value when interest rates rise. If your retirement account shifted into long-duration bonds when rates were low and rates have since risen, those bonds are worth less today than when you bought them. You may not see this loss because it does not always show up clearly on a retirement account statement, but it is there. Ask your financial advisor or log into your retirement account and look specifically at the duration of your bond holdings. If you are holding significant amounts of long-duration bonds right now, talk to a professional about whether short-term bonds or treasury bills would be more appropriate for your specific situation. This conversation could be worth tens of thousands of dollars. Move 5. Build your financial buffer before the end of this summer. I said earlier that the right financial positioning serves you whether a recession comes or not. This is the move that makes that true. 3 to 6 months of living expenses in a liquid, accessible, high-yield account is the single most powerful financial position you can hold going into an uncertain economic environment. It means that if something goes wrong, job loss, medical expense, market crash, you have time and options. You do not have to sell investments at the worst moment. You do not have to take on debt. You do not have to make panic decisions. And if nothing goes wrong, that money is sitting in a high-yield account, earning 4 to 5% while you wait. You lose nothing by having it. You gain everything by having it when you need it. If you do not have this buffer yet, start building it now. Cut one unnecessary expense this week and redirect that money to a high-yield savings account. Do not wait until you have a plan to save the whole amount. Start with whatever you can. The habit and the account structure matter as much as the balance in the early stages. Let me bring this all the way back to where we started. That number, 4.67, the yield on the 10-year Treasury that made experienced traders go quiet. It is not just a market statistic. It is a message from the collective judgment of every serious investor in the world, from the people who spend every waking hour analyzing the economy and putting real money behind their conclusions. And the message is this: the path ahead is uncertain. Inflation is not defeated. The debt burden is real and growing. The cost of borrowing is staying high longer than most people hoped. The risks are present and they are not small. That message is not comfortable, but it is honest. And honest information is the only thing that gives you the ability to make genuinely good decisions about your money. You now know what most Americans will never know about: why their mortgage costs what it costs, why their savings account is paying what it pays, why their retirement account is behaving the way it is, why the grocery store feels more expensive than the headlines suggest it should. You know why, and you know what to do about it. The bond market has been sending this message for months. Most people will not receive it until the consequences are already showing up in their bank accounts. You received it today. Now do something with it. Check your savings account rate today. Look at Treasury Direct Gov this week. Call your lender if your mortgage is adjustable. Review your retirement account bond allocation. Start or increase your financial buffer before summer ends. 5 moves, none of them complicated. All of them available to you right now at zero cost with the information you have right now. This is Money Alert. We exist because the financial system was not designed to explain itself to the people it affects most. Every week we take the most important money story happening right now and translate it into something you can actually use. If this video gave you something real, subscribe and hit the bell, because next week there is another alert coming, and in the current environment you cannot afford to miss it. I will see you in the next one.